The Great Recession of the late 2000s was a painful reminder of how interconnected the global economy can be. The events of that time led to a global financial crisis that took years to recover from. Fast forward to 2023, and the US economy is once again facing challenges that could potentially lead to another recession, officially. One major concern is the US debt ceiling. The country's running out of time to raise the debt ceiling before the Treasury Department's extraordinary measures are exhausted. If the debt ceiling is not raised, the US would then default on its debt for the first time in history, leading to a downgrade of the US credit rating, higher borrowing costs, and of course, a recession. We know that they'll increase the debt ceiling, but this is the concern that they're facing. At the same time, inflation and rising interest rates are also big concerns because the US and the Fed are still uncertain about speeding up the hikes. Chair Jerome Powell noted this, and we'll talk about that today. Credit growth in the US has slowed sharply, and consumers are feeling the impact of higher borrowing costs, making them less likely to take on debt. Rising mortgage rates are making it more difficult for some Americans to afford homes or refinance their existing mortgages. We look at all of that data that has come through, how many mortgage applications are there. It's really down significantly. These economic challenges are having a significant impact on Americans, particularly millennials and those living in poverty circumstances. Millennials are struggling with record high levels of debt. They've got their student loans. They've got everything that have piled up on top of them. And so that puts us in an interesting predicament for 2023 because it doesn't look like interest rates are going to come down. And we're in that zone of, going through the rest of the year with high interest rates. It isn't something that could be reversed in the near future. Okay, we are going to persist with this. And I want to see what happens today. Let us begin by talking about our friend, Jerome Powell. Well, Jerome Powell was grilled in front of the Congress, as happens every so often. He made it very clear, and in fact, I gotta say, very infrequently will I agree with somebody from the Federal Reserve, but in this circumstance, I actually did. He was making the case why inflation is too high, interest rates need to stay up, and as a result, the Congress was saying, you're going to put people out of work, you're going to put people out of work, and he was kind of saying, look, the official unemployment rate is at 3.4%, so it's okay, kind of thing. That if we don't, tame inflation, you're going to be in a world of hurt. And they just grilled him, and he was not feeling too well at the end of that. Let me tell you. Well, I wanted to show you this because here's a quote. And I stress that no decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. And so what I take from that is that we will see a 25 basis point hike here in March. And if the data that comes through is actually like running real hot, then they're going to do a 50 basis point hike. And then the next one coming, maybe that's another 50 basis points. That's what he's trying to say. So they're going to monitor it, incoming data, nothing really new there, but the market really didn't get what it wanted. And you could see there's a lot of red, if you could see over my shoulder, a lot of red recently as Jerome Powell's making it clear that, yeah, actually you're not going to get rate cuts in 2023. And we are okay with a recession. That's kind of what they suggested during this period of time grilling with Congress. Now, I sit there and I watch the grilling and I watch the Fed conference. I do that. Why do I do that? So that you don't have to. If you want all that information and not just, you're getting news headlines and things, you got to stay tuned to this channel. Subscribe. I'll bring you all the best stuff. Okay. This is important to see the fact that Fed's Powell, he's seeing long-term damage if the US debt ceiling is not raised, of course. And that is true. They need to raise that debt ceiling because they can't actually cut from their funding. They're never going to cut out dollars. They're always going to spend more money than they had before and go into more debt over and over and over again. Okay, we know that direction. So certainly they have to increase that or else we're in big trouble in this summer. Okay, so it's just coming up, a few months away. And, what will they do? How are they going to prevent a default? We've seen this before. They could start shutting down parts of the government to keep it going, but we know We know, we're smart enough. We realize they're going to raise that debt ceiling. But along with raising that debt ceiling is going to be massive expenditures on all things that are truly wasteful. So we'll see what happens. Failure to raise the debt ceiling could result in a downgrade of the US credit rating, leading to increased borrowing costs. So that's something that you could experience maybe for a period of time, or maybe the rating agencies will say, you know, when we were tired of this cat and mouse game, we're going to downgrade. We will see what happens though. Looking at the next aspect about that debt ceiling is the fact that the US is running out of time. The department's extraordinary measures that were put in place, my favorite Janet Yellen talked about that, well, they're being exhausted. So you have a few months to go. If the debt ceiling is not raised, the US could default on his debt for the first time in history. Does anybody actually believe that? Not so sure, okay? But we're going to look at it over time and see what happens. So we bring ourselves to this. Layoffs, burnout, return to office wars. There's never been a worse time to be a middle manager. These are, about the job situation that's happening, and it's a very unusual situation for jobs because there are millions of open jobs. At the same time, you have a lot of people that are on food stamps. You have a lot of people that have 2, 3, and even 4 jobs in some circumstances. So things are really, really out of whack, okay? Like it's just not normal. Consumers are feeling the impact of the higher borrowing costs, and they may be less likely to take on debt, and debt is needed to expand this broken system. The slowdown in credit growth could have negative implications for the US economy. We know this to be true, and we've seen it for so long. That also connects in with this. Even in the midst of layoffs, employees are pushing back on the return to office mandates. You've probably seen this before, but ultimately, for a lot of these groups, they are saying, we're not going to go back. I don't care. I love being at home. It is so much easier. Traveling is terrible, all this stuff. And so they're pushing back on it. And because of what has happened, because of how difficult it was to get people in, and knowing that they had to give them more money just to get them in, especially the good talent, they're saying, well, fine, well, we're going to accept that for now. But I do believe that if we do enter an official recession and we do have more of a deflation and so on, that I think a lot of these employers are going to say, hit the road. If they don't play ball, hit the road. So watch out for that, okay? Unless you have some sort of very specialized talent, unless you do something that nobody else. I remember working in a place where there was a guy not far away from where I was, and he was the only person in the company who understood this one thing. We're talking about multi-billion-dollar company here. He was responsible for operating a section of that nobody else could do. Nobody else understood it. And it was literally critical that he was there. So imagine the job security he had in that position. So if that's you, maybe you can say, I'm going to work from home, too bad for you. But if not, be careful. That's all I'm trying to get at here, okay? So let's talk about this. It's important, okay? Because with the debt circumstances, it's not just one country or another. Everywhere, the debt is going off the charts. Millennials are sinking under the weight of their debt, adding a record $3.8 trillion to the pile last quarter. And here's what's driving that. They talk about these issues here. But for a lot of people, you can see that debt is overwhelming, whether that's student debt, whether that's credit card debt, all of these other things that has been piling up right now. Student debt is one that I think a lot of people are not going to pay it back. That's just my guess on this, that they're going to say, hey, we saw a bunch of people getting away with not paying it, so I'm going to do the same thing. I'm just going to let it pile up. And that's concerning, of course. Depending on your circumstances, maybe they'll just say, okay, we're not going to charge interest on it. Are they going to pay it back? Probably not. Of course, 2020 made the situation worse. Many millennials losing their jobs, experienced reduced working hours. Experts warn that the debt could have long-term negative effects on their financial well-being and the broader economy. And we notice this because they're moving in with their parents, or their parents are moving in with them, and they're kind of sharing the resources. That's happening right now today. And it is a big problem, okay? And you see that coming up in the data such as this. 37.9 million Americans are living in poverty. That's according to the US Census. And it's even worse than it could be according to these numbers. Think about this. 40 million people, you look at that, approximately the same number, are on food stamps. This is huge because a lot of the people are basically, if somebody is in that level of debt, they're in poverty, the circumstances, they go to, they do things that maybe they didn't want to do before. This is, people that have abundance and people that have prosperity, they act, hopefully, everything's kind of normal. But when people have nothing left to lose, they lose it. You've probably heard that. Gerald Celente is famous for saying it. Well, the number of Americans living in poverty may be far higher than the official figures suggest. The official poverty line is based on a formula from the 1960s that fails to take into account other factors such as housing and healthcare costs. And what has happened to both of those? Both of them have skyrocketed. You look at any of those charts, I showed you one a few days ago, that showed the cost of your healthcare going through the roof. Now, hopefully you don't have to utilize the healthcare, but a lot of people do, especially as they get older. And those costs go up, but their income doesn't. Experts say that more accurate measure of poverty would show that the problem is much more widespread than currently reported. And that's why I discussed the pillars of prosperity. Please learn about that. Pillars of prosperity, the money GPS. Pillars of prosperity, the money GPS. You search that up and I just break it down, what people need to be doing right now today. All right. And yeah. All right, the U.S. mortgage rates increased for the fourth straight week. We could see the data coming through. This is putting additional pressure on people that are trying to buy a home right now as the prices are still way, way too high. And it is beyond our imagination. And then you look at China's weak inflation eases the pressure on global prices. That, of course, would be good news. You can see there's been so much pressure from every angle and we need to see some positive numbers coming through. I talked about the fact that freight rates have come down internationally, but my experience, I just brought a shipment in of 2,000 units domestically inside the United States. And my goodness, I couldn't believe it. I had to recalculate it multiple times. The price over the past, let's say 2 years, has multiplied, I think it's almost by 4x, 4 times higher, utilizing, just truck transportation. That's inflation. That's some serious inflation, okay? That is extreme, 4 times higher. I was paying something like, let's say, 4 cents a unit. I think I paid 17 cents a unit, 18 cents a unit this time around. So those prices, I hope they go down, just like the other freight rates, but part of that is because they say they don't have enough truck drivers, they don't have enough people working at the docks, they don't have enough people working at the warehouses, all these things. I don't know what to believe. I think a lot of that is simply that they want to make higher profits and they're taking it out on the people. But guess what? Then you have people who say, okay, well, that just squeezed my margin down. I have no margin left. I'm not making a profit. I'm taking the risk. So now I increase the price. How often can you do that? Well, there's a ceiling and that compresses what you're able to do. This is not good. Inflation eventually runs into a problem. You have a breakdown that occurs, economic contraction, and then we run into some major issues. Do you see what I'm going with? If you want more info on that, let me know. Let me know what you think, as well as I'm getting a lot, because I mentioned it a few times, people want like mentorship in terms of their businesses and things, and I'm working on the next level of the Amazon GPS course. But if you just want like one-on-one time, if you notify me, we can work something out, okay? But that goes for businesses, people who want some of that insight. I'm also working on a business course to help people go from like nothing to be able to start their own businesses, step 1, 2, and 3. I do this personally, but I haven't actually condensed that down into a course. So if you want to know about that information, always you can let me know. And that's it. I'll see you tomorrow. Take care.